The child tax credit is getting some enhancements starting this year, 3 of them. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Tax deductions are good. Tax credits are great. Okay, deductions reduce your taxable income, and then you pay tax on a percentage of that, right? So think of the standard deduction. You add up all your income, and then you subtract the deduction, $31,500 for married filing jointly, and then the remaining amount after that deduction, that's what's multiplied by the progressive tax rate system. So deductions save you a percentage of tax. Tax credits are great. They are a dollar for dollar reduction of your tax bill. After your income, you add it all up, minus those deductions, get you to your taxable income. They multiply that, your tax preparer, your software, whatever, multiplies that by the progressive tax rates. Then you compute your actual tax. That's when credits are a dollar for dollar reduction of those taxes that are calculated. So deductions are good. Get as many of those as you possibly can. Do the tax planning to qualify for as many of those as possible. Get those, but then credits are great. Absolutely optimize and maximize those as well. Planning ahead for your taxes, looking at the creative ways that you can improve or enhance or optimize your deductions in your credits. That proactive work, that's tax planning. That's the work you need to be doing with your certified financial planner. Well, one critical tax credit that many families really use to improve their tax picture every year is the child tax credit. This is a tax credit that you get for dependent children starting the year that they're born, and then you lose it the year that they turn 17. Why 17? Why not 18 or 19, something like that? Why 17? Nobody knows. No one knows. Makes absolutely zero sense, right? They're still a dependent when they're 17. They're still in high school when they're 17. That starts to change when they're 18, and yet the child tax credit from age zero, right when they're born, until the year they turn 17. So the year they turn 17, you no longer get the child tax credit for them. But this is a meaningful amount. The amount has been changing for the past several years, the past 8-9 years. The amount's been changing. But with the new tax laws, 3 important changes to the child tax credit you need to know that start this year, 2025. First, the tax credit is now $2,200 per eligible child. That's right, $2,200. It was $2,000. It's gone up to $2,200. That is fantastic. Way back when, before the Tax Cut and Jobs Act in 2017, the child tax credit was $1,000. If your child was, again, from the time they're born until the age of 17, it was $1,000. And then Tax Cut and Jobs Act moved it to $2,000, but it was temporary. But then during COVID, with a lot of stimulus, there were some changes to the child tax credit. They moved it to $3,000 or $3,600, depending on the age of your child. And even for a brief moment, they included that age 17 and it went away at age 18. But that all was just temporary and so on. So it reverted back to $2,000. And now with the new tax laws, it's moving from $2,000 to $2,200, and that starts in 2025. So your child tax credit is going to be even higher starting this year. The second change is that more of that child tax credit is refundable. That's right, $1,700 of the $2,200 child tax credit is now refundable. Well, what does that mean? Again, with your tax planning, you're going to be looking to optimize how many deductions and how many credits do you get. Well, if, based on seasons of life, whether you're retired or early in your career or depending on your financial situation, if you have a lot of deductions that reduce your taxable income, and then you calculate your tax, and if you have a lot of tax credits because you've got a lot of kids at home, maybe some dependent care credits, maybe some, even if you've got a wide range of your kids, maybe you've got some college credits as well. If you have enough deductions and then credits to wipe out all of your federal tax, that's fantastic. But what it means is that you then may not get all of the child tax credits that you could, because if it wipes out all of your tax, well then what do you have? Well, up to $1,700 of a $2,200 child tax credit is refundable, meaning if it wipes out all of your tax, some of it goes down below as if it was paid in, as if it was a withholding or a payment that you made as what's called an additional child tax credit. And that's right, a higher percentage or higher amount, I should say, of the child tax credit is now refundable for those of you, again, where you've got deductions and credits that wipe out all of your tax. More of these dollars can expand and increase your refund, what you receive when you file your taxes. $1,700 of the $2,200 is now refundable. And then the final change coming to the child tax credit this year is this new structure is now made permanent. And I'm putting permanent in air quotes because it's only permanent until Congress decides to change it again, but there's no expiration date. Back when the Tax Cut and Jobs Act moved the child tax credit from $1,000 to $2,000, that was a really big jump. And it was all those tax rules, including that increase of the child tax credit, was set to expire at the end of 2025 and revert back to the old rules if Congress didn't act. Well, Congress acted in this new tax law that was passed in July, and there is no expiration date to this higher child tax credit of $2,200. So that's a third big update with the child tax credit. So good news for those of you that have kids, be either just born this year or still yet to be born this year. One of our colleagues is going to have twins here coming up in a couple of months, and so she'll be eligible for these child tax credits, but all the way up until your kids turn 17, which is the upper band of my kids. Make sure you're planning ahead for these. The other planning point is there is still a phase out, meaning if your income gets too high, you could start losing some of these tax credits. $200,000 for single filers, $400,000 for married filing jointly. That is adjusted gross income. So if your income is near those thresholds, or maybe your wages, your earned income isn't near those thresholds, but you've got some capital gains or received some other resources that's pushing your taxable income up a little bit higher, make sure that you're doing planning to stay below those levels and optimize and maximize your child tax credit. So work with your certified financial planner on that. Be doing that proactive tax planning. Take advantage of these higher child tax credits starting this year. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us here as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.